But this will be about a 20-minute overview of, well, first of all, what good tax policy looks like, and then sort of where Georgia stands both in light of other states and within the region, because I think regional comparisons are especially important because we do live in a unique country. We like to say the phrase laboratories of democracy quite a bit, and that's very true because there's a lot of places that a company or a person can live, and I think that taxes are definitely something that, a consideration that people have. So I'm going to just walk through this real quickly. I'm going to talk about Georgia's economy. There's very briefly I say, because I have 2 slides, and I don't think that any state economy can be explained in 2 slides, but these are just 2 background things that I think inform the tax policy debate. Second, I'm going to go into the overview of Georgia's tax code from 3 perspectives, the corporate income tax, the personal income tax, and then the sales tax, because these are the sort of the big fish, and I think that Senator from North Carolina will be able to provide some insight on how reforms went to these taxes in North Carolina. And then some barriers to competitiveness in Georgia, some issues that maybe Georgia faces. You mentioned an income tax that's been the same for several years, and then what we can do to reform Georgia's taxes, because this is the most important. It's important to talk about where we can go from here and what can be changed and make the state an even greater place to live and do business. So I think the most important way to tear down that wall to economic growth is to talk about what good tax policy looks like in the first place. A big wall, I think, is that nobody knows what it exactly looks like, and so if we can help direct that, that's a great place to start. So first of all, smart tax policy is simple. It's easy to understand. It's easier for me to understand as a taxpayer. It's easy for the tax department to administer. Simplicity is good not just for being able to predict what your tax liability might be easily so that you can make decisions based on that, but it's also good for voluntary compliance. You want people to want to comply with your tax because it's easy, because that's good for revenue, and it's good for bringing that revenue for the state to do things with. The second thing that marks state tax policy is transparency. Now, there's a lot of reasons that a tax code should be transparent, and I think that the main one is that your taxpayers should know what they need to do and how they need to do it. Go on a wild goose chase to figure it out. Thirdly, tax policy should be neutral, and I think this one is often the most controversial because you've got two sides of the aisle here, I think. You have people who want to raise tax revenue for simply revenue and tear down that wall to economic growth. I love that you called this panel that, because taxes shouldn't get in the way of decisions. We should be raising revenue, but we shouldn't be encouraging people to make decisions based on how our taxes are structured. As they stand, should not stand in the way of business growth. They shouldn't stand in the way of people's decisions. They should be there to bring in revenue and bring in revenue alone, and a neutral tax code will do that. Finally, smart tax policy. And then on the predictable side, it's easy for me as a taxpayer to guess what my tax bill is going to be. Then I don't have any surprises, and I won't have to do nasty things like lay people off or invest less in my business. I know what's coming, and I can expect stability, and that's very important for taxpayers. And then above all, smart tax policy is pro-growth. I think that kind of encompasses all of these things. We don't want tax policy to stand in the way of growth. We want our economy to grow with the tax system that we've got. So I think now is a good time to talk about Georgia very, very briefly. If you look up here, you'll see that Georgia's income per person tends to be below the national average, but it's just about in line with the rest of the region. So the region as a whole tends to be below the average, but historically, Georgia, you can see, is the purple line. It has kind of skated up above the regional neighbors, but then in recent years, so this only goes through 2011, because of some data limitations with comparative data sources, you can see that Georgia's kind of ticked down in the middle of the pack compared to its neighbors. And that's not something we want. We want Georgia to be flourishing, and tax policy is something that can play a role in that. It's not the only thing that people consider or the only thing that drives an economy, but it's definitely something that we should not ignore. And then this one I think is really important when I get into my sales tax discussion. Georgia isn't a goods-based economy anymore, and this is true for the whole country. You can see that if we look at goods versus services GDP as a share of all of the production in the state of Georgia, goods is going down over time and services is going up. Now, this has huge implications for the tax code because, as you all know, we don't really tax services. It's leaving out a huge piece of the pie, and I'm going to get into this more, but this is going to inform a lot of what I talk about, so I wanted to put it up here real quickly in my discussion of the economy. So I think when we talk about taxes, one of the key things we want to mention is competitiveness. There's 50 states that somebody can live, 50 states where someone can do business, and they have a lot of, people have preferences and they have a lot of choices that they can make, and so making your tax code competitive is very, very important. There's a lot of ways we can compare tax codes. There's two that I'm going to talk about today. There's the how much question, how much revenue do we raise, what's the tax burden compared to other states, and then there's the how question. Once we decide how much revenue we want to raise, how do we do it? How do we do it so that we don't stand in the way of growth and we don't stand in the way of the economy? When you look at Georgia, you can see here the purple line is Georgia and the blue line is the US average. Georgia has traditionally been below the US average when it comes to tax burdens, and that's a good thing. You know, with a low tax state, that's something that companies and people consider, and so that's a feather in the cap for Georgia. So not surprisingly, if you look at the country as a whole, you see Georgia is ranked number 35th. It's lower than most states. It's in a low region as well. So I think when we zoom in on the region that Georgia lives in, the region, the neighboring states, we'll see that there's some competitive issues that I think we can improve in the case of Georgia. So when we look at the how question, this is where I think this is the most important consideration, because the level of taxes is not the only thing that we need to think about. We need to think about where that revenue is coming from, because when I brought up those 5 things that you need to think about smart tax policy, that's really what informs the debate, and that is how taxes are raised. So if you look at the business tax climate of the 50 states, you'll see that Georgia is not the worst, but it's also not the best. So raise your hand if you've heard of the Tax Foundation's State Business Tax Climate Index. Anyone heard of it? We've got one. Okay, so that tells me I need to explain it a little more. So this is an index that we put out every year, and it ranks all 50 states on the how question. So 100 variables that are related to business tax climate, and it ranks the states on those things and boils it down into one easy to look at number to make the states comparable. And so it looks at things like how high are the rates, how many brackets does the income tax have, what kind of investment credits and things are offered, do we apply the sales tax to business inputs, what's the property tax burden. So it's a lot of complicated things boiled down into one number so that we can compare the states. So if we look at the region, here you've got a regional zoom in of the business tax climate. You'll see that Georgia is ranked 32nd in the country, but when you look at it compared to the rest of the region, it's middle of the pack. Now on this index, you want to be number 1. You want your business climate to be the best. So 32 is on the lower end. You can see that only South Carolina and North Carolina are behind Georgia as of 2014. So it's middle of the pack, but there's a few important considerations to think about because of our neighbor North Carolina. North Carolina did a lot of things in 2013. I'm not going to get into the details yet because Senator Wilsby will talk about those, but the 2013 reforms that North Carolina did could bump it as high as number 17 when they're fully phased in. So that's going to bump Georgia down one more and make it so only South Carolina is ranked more poorly than Georgia. It's also important to remember that Tennessee doesn't tax wage or salary income. It only has a tax on investment income, so it's kind of hard to compare Georgia and Tennessee on that respect. And then finally, Florida has no personal income tax. So Georgia's got a lot of really big regional competitors, and it's important to think about that because there's a lot of things about Georgia's tax code that we could maybe improve to make it more competitive with its neighbors. So this is that map superimposed on a table. So you'll see that our index score, we've got an overall rank in that far left column. Like I said, Georgia's ranked 32, and then we break it out by tax. Because it's instructive to look at each of the individual taxes and how they're structured. You can see that Georgia has a pretty good corporate income tax climate. But conversely, it has a pretty bad individual income tax climate, 41st best in the country, which means 40 other states have better income tax codes than Georgia. So moving on, like I said, how are these revenues raised is an important question. And so this slide kind of looks at how Georgia gets its tax revenue. It's pretty similar to other states. It's the largest chunk, if we lump state and local taxes together, largest chunk comes from property taxes, followed by sales taxes, and then individual income taxes. You'll notice that the corporate share, the orange wedge, is very small. It gets a lot of attention, but states don't get a lot of revenue from corporate income taxes, and it's going down over time. And so I think that should inform the debate as well. There's a lot of reasons why maybe you might want to not look at corporate income taxes as a way to raise revenue for the state. I'm going to point out that sales taxes, if you lump all of the sales taxes collected in Georgia together, most of them will be at the lion's share will be at the state level, but as we all know, there's a lot of local add-on sales taxes that you see in the counties across Georgia, and that brings that rate a lot higher. So it's an important consideration, the local side there too. Corporate income taxes and individual income taxes, conversely, they're state level taxes. It's only the state uses those taxes, not local governments. So if we go to corporate income tax competitiveness, I'm going to get into this first because I think it's interesting that corporate income taxes gain the most attention because they are a very small share. If you remember that tiny little orange wedge. Georgia's corporate income tax is structured better than most states. You'll see again, it's number 8, but it's still a corporate income tax. It's kind of like putting lipstick on a pig sometimes, I think. It's structured well, but that doesn't mean it's a good tax. It's structured as well as it can be, I kind of like to say. Corporate income taxes are, by nature, very inefficient. They grow slower than the economy, and they jump around a lot. They're very volatile. So if you look at Georgia's state and local income tax collections over the last 30 years, since 1977, I guess 40 years, you'll see that top line moves around quite a bit. You'll notice there's a gap here because the census decided not to collect local data in 2001 and 2003, so we've got a gap there, but you can still see the trend. It jumps around a lot. That's not very stable. You can imagine that if your tax code only depends on things like this that bounce around, you might run into trouble with budgeting. And you can especially see there on the right that after the recession, you see a really big dip in corporate income tax revenues, and that's because they tax the things that bounce around the most when the economy changes. So they're low growth, they're highly volatile, making them not a very efficient revenue source for states, and so that's something to consider as you look at changing a state's tax code. The rate is regionally high compared to a lot of other states, and the tax base could be a bit better. So the flat rate, the 6% is tied with Tennessee, North Carolina, but as we know, North Carolina did a lot of recent changes, and it's going to drop down to 5%, and then if certain revenue triggers are met, it's going to go down even lower. So it's going to be a lot less regionally competitive moving forward if it stays where it is now. It's tied for second highest. If you look at the rates here on corporate income taxes, you'll see Georgia is at 6%. If we look at the base, so there's two important questions when you look at a tax. You want to look at the rate and you want to look at the base, which is all of the things that we tax. What do we apply that rate to? Georgia's got a lot of carve-outs, a lot of things that chip away at that base, and I've got a couple off the top of my head here I'm going to read to you. You've got a jobs tax credit, you've got a quality jobs tax credit, you've got R&D credits, you've got a mega projects tax credit, investment tax credits, and then everybody's favorite film tax credits. These take a big bite out of revenues. They carve away at the base, and I always think that if you've got to offer these types of incentives to make your tax code look more competitive, then your tax code probably isn't very good to begin with. So it might be better to look at kind of closing some of those carves out, broadening the base, and then lowering the rate on everyone, making it more neutral and a lot more fair, in my opinion. The corporate rate has been the same since 1969 in Georgia. That's a lot better than a lot of other states. A lot of other states ratcheted it up during the recession, did a lot of changes, which is the opposite of stable. But I want to point out, you'll notice this flat line since 1969 is about the same time period as this entire graph. So even though we've had the same corporate rate, revenues have not been stable. So that's an important consideration. It's partially because of the economy, partially because of changes that have been made to the base. But the main point is that this revenue isn't stable. So some ideas maybe to reform Georgia's corporate income tax. Like I said, lower the rate to maintain some regional competitiveness. Get rid of a lot of these tax incentives and carve-outs. It looked like last year, or this year, the film tax credit here was going to be $86 million, so that's not a small penny. So close some of those carve-outs so that you can bring down the rate. And then recognize that corporate income taxes aren't very good tools for revenue in the first place. So think about maybe moving away from them and more towards other types of taxes that might provide more stable revenues over the business cycle. So like I said, you've got the worst of both worlds. So if we look into, we're talking about business taxes. I think we can talk a lot about corporate income taxes, but we also forget that businesses pay a lot of other types of taxes as well. So this chart shows if we add up all of the taxes that businesses pay, where do those taxes come from? You'll see that if we've got the orange bar here, it's the tiniest share. It's the tiniest thing that a business will pay. The largest is property taxes, and then the second largest is actually sales taxes. And then we've also got some individual income taxes here on business income, which is that yellow bar. So these structures matter too. Sales tax and individual income tax matters to business as well. So just to reiterate this point, a large share of employers in Georgia, in fact a majority share, are pass-through entities. That means they pay individual income taxes, they don't pay corporate income taxes. So here you see on the top is the Georgia state average, so all of the sectors, 63% of employer firms are pass-through entities that pay individual income taxes.
A lot of these are small and medium-sized businesses.
Yes, exactly. They're smaller. I think it's an important consideration. Maybe we can't just talk about the corporate income tax, we have to talk about the individual income tax. You'll see the 5 largest sectors of Georgia here, private sectors. Their big chunk are paying the individual income tax, so we have to think about that as we think about the tax code as a whole. So jumping right into personal income tax competitiveness, I'm going to abbreviate this so I don't get too wordy on my slides here. Again, Georgia's tied for second highest top personal income tax rate among its neighbors. We're again at 6%. But again, we have to remember that Tennessee does not tax wage and salary income. It only taxes investment income. So even though it's tied with Tennessee, the base is much smaller.
Tennessee's in the process of trying to get rid of it.
Yes, they're trying to get rid of it. It's a small revenue share and they want it to be 0. So if that goes as planned, then there will be another state like Florida that doesn't have a personal income tax in the region. So South Carolina is really the only state that's worse in this respect. So second from the second highest isn't a good place to be in the region. So you might want to think about bringing that rate down to make it more regionally competitive. So like Kelly pointed out, the existing tax bracket structure in Georgia was created in 1937. It was very similar to how it looked today. The top rate kicks in at $7,000. So can you guess for me, what's the buying power of $7,1937 today? Do you have any guess what that could be? Way higher, way higher. It's actually $115,000. So the tax code here is very outdated. The buying power of someone in the top tax bracket is a lot different back then than it is today. And so it's time to modernize that. It's time to kind of bring that in line with the modern economy and maybe adjust that for inflation or make it a flat rate so everybody pays the same rate. So that's a lot different. I'd like to point that out. So like I said, bracket levels have not been updated and they haven't kept pace with inflation. This is something we call bracket creep. So as inflation makes prices higher, you have less buying power over time, but you get ratcheted up into a higher and higher tax bracket. This is more evident at the federal level where we have a much more progressive rate. You end up paying a lot more in taxes, but you don't have any more income in real terms, and so that's a problem. You want to make sure that that doesn't happen over time, and a way to do that is to do what we call indexing for inflation, so that will kind of rise with the price level as price levels change. So states fiddled with taxable income, exclusions and exemptions during that time. There's a big list of all the changes that have been made in the handy book you sent me, but the brackets haven't been touched. So a good idea here would be to we might as well just go flat, tax everybody at the same rate, and then have a generous standard deduction to account for those regressivity concerns that we all have that are very important. So going flat is good. North Carolina did that, so I think we'll talk about that a little bit more, but it's a good move to make. Makes things simpler to calculate, just a good thing, a good move overall. Other issues that Georgia has, I was confused when I was doing my research for this because Kelly had told me that we had gotten rid of the marriage penalty in Georgia, but Georgia hasn't really gotten rid of the marriage penalty. It fiddled with some things to try and fix it for certain levels of income, I understand.
Personal exemption.
But if you look at the tax brackets, there's still a marriage penalty. You ideally want it just to be doubled for married filers. So there's still a marriage penalty in Georgia that can be fixed. An earned income tax credit is something you can think about if you've got regressivity concerns as you move to a sales tax, if that's something that Georgia wants to do. And again, there's lots of carve-outs. We've got a child care credit, charitable contributions credit, or deduction, retirement income exemption, various business credits, like we said, businesses pay the income tax. So there's a lot of things that carve away that base that maybe could be eliminated to bring that rate down if and when you want to make it flatter. Oh, there we go. Okay, so ideas for reforming the personal income tax, like I said, flatten it. You could combine the personal exemption and the standard deduction, make it more generous. North Carolina did this, make things simpler. Get rid of some of those carve-outs, lower the rate, GASP, tax retirement income, maybe that's controversial, but it's something that you can think about. You could change the low income credit to be more like an earned income tax credit to kind of look into those work disincentives that might come up. Get rid of the marriage penalty and index brackets or the standard deduction for inflation. So moving right along into sales taxes. This is my favorite thing to talk about just because of that chart I showed you earlier with services versus goods. This is something that states are facing and it's not going to go away. There's a lot of things that are chipping away at the sales tax base. Online purchases is another one that's very popular. There's a lot of things that are making sales tax revenue not as robust as they used to be, and that's a big opportunity for reform in a lot of states, and Georgia's no exception to that rule. So this chart is really interesting. It's the sales tax breadth, and that's kind of the idea of the sales tax base. How much of our purchases are subject to the sales tax? And you can see this is going down over time, and I don't expect that will change if we keep taxing the same things that we tax. It's going down over time drastically, and so if we remember this chart, you can see that there's a lot in line with the way that the goods economy is moving. So we used to tax goods when the sales tax was invented in a lot of states. The purchase of tangible personal property was taxed, and at the time when we were a goods-based economy, that was a good, reasonable approximation of how the economy worked. As we move forward, though, you can see that that's not true anymore. A bigger and bigger piece of the pie is going to services. Bigger and bigger piece of the pie we're buying online, and if we don't address that, this trend will only continue. So if we look at services taxation, because I think this is a really interesting thing to look at, Federation of Tax Administrators tallies the services that could be taxed. This is an outdated list because they haven't done it in a while, but last count, out of 168 services, Georgia only taxed 36 of them. That's really tiny. You'll notice that Tennessee and Florida tax a lot more. Alabama and the Carolinas are kind of in line with what Georgia taxes. This doesn't include a lot of things. This doesn't include lawyers. It doesn't include dentists. It doesn't include architects. I included taxidermy because I thought that was kind of funny. That's not taxed here either. Tax return preparation, cable and satellite TV. So a lot of services that people use that aren't being taxed. And when we look at that combined with the rate, you'll notice that Georgia sits in a region that traditionally is pretty high sales tax. The South tends to be on the higher end when you look at state and local rate together. So like I said, state has a rate, there's a lot of local add-ons that we can't forget because that's a high sticker price that people pay, and you can't forget that that's an important consideration. Florida and North Carolina barely have lower average rates, but you'll notice that Florida taxes more services, and North Carolina has started to add more services to the base as a part of this 2013 reform that they did. So they've got broader bases, and the rate's a little different, but it's important to talk about both. So a key consideration that we always have to point out when we talk about sales taxes, though, is that businesses also pay sales taxes. We don't want them to pay sales taxes. This bar should ideally be zero. And when I say that, people say, well, you just said that there shouldn't be exemptions. We should broaden the base and lower the rate. Well, that is true, but that is not true for business inputs, because if businesses pay sales tax on their purchases, a little thing called tax pyramiding happens, where as a business buys something early in the production chain, they're going to pass that tax on, and that tax gets embedded and embedded and embedded, and it piles up on top of each other as we go through the production chain. So that's not neutral because longer production chains are going to have higher rates, higher effective rates, and shorter ones are going to have lower rates. And that's distortionary, and that's not something that we want to happen. So in an ideal tax code, we'd want that blue bar not to exist.
A lot of tax experts would agree that taxing business inputs with the sales tax is the absolute worst tax policy.
The worst. It actually, if you look at it economically, if you tax all the steps of the process, you actually have what's equivalent to a gross receipts tax, and we all know that that's a terrible model to follow. We don't want a gross receipts tax. We don't want a margin tax, and that's kind of what they resemble.
Several states have gross receipts.
About 5.
Texas.
It's a modified. It's sort of, if you want to talk about the worst of both worlds in terms of that tax, it's corporate income tax combined with gross receipts tax, so it's sort of the worst that you could come up with. But that's not something that you want to emulate. And so you want to really take care, if you're going to expand the sales tax base, not to hit business inputs. You want.
I want to stay on that. One of the good things that we've done here in Georgia, one thing that we were taxing that has a big impact on a lot of our businesses was energy.
Yes.
The manufacturing process and agriculture. We got rid of that, at least on the state level, a couple of years ago, and I think we all know we've seen the businesses that have moved to Georgia and the expansion we've seen because of that.
Absolutely, absolutely, and so it does matter to business, and I think that especially since that's the second biggest bar we see here. But the bad news is based on, this is an old chart because this study hasn't been done in a while. I wish that someone would redo it, but in 2003, which is obviously a decade ago, Georgia was the worst about business inputs. That's gotten better, but it's a pretty big chunk, 45% nearly of the sales tax in Georgia is paid by businesses when that should be 0. And it's not because businesses should be exempted or they deserve special treatment. It's for very valid economic reasons. And people on the left and right will agree with you on that. It's not a conservative opinion or a liberal opinion. It's an economic opinion that should not be ignored. So if we want to, this is the controversial part. How can we reform the sales tax? You could tax groceries. When I say that, people sort of freak out that we can't tax groceries. That's regressive. Well, I am surprised to tell you that rich people buy groceries too. So you can't forget that that's leaving out a big chunk of the pie. There's a lot of things you can do to combat that regressivity concern, but when we talk about stability, what's something that you never stop buying? Groceries. Economic times are good, you buy groceries. Economic times are bad, you buy groceries. This is a really stable revenue source that's not going to bounce around with the economy, and as you broaden that base, you might be able to bring down the rate, so there's less of a hit there. If you want to deal with the low income issue, which is a valid concern, we shouldn't make fun of the regressivity concern because it's a valid concern to have. You can create something like a prebate or a credit for low income taxpayers to combat this increased sales tax that they might pay. So you can have the best of both worlds. You don't have to trade growth for regressivity concerns. So
and individuals who are using food stamps,
absolutely,
they're not taxed.
So you'd want
as well.
You could do it a lot of ways. You could make it a credit on their income tax. That's it's kind of complicated. You could make it beforehand, so they don't have to come up with the money first and then still pay tax. So they have it beforehand. There's a lot of things you can do to make sure that low income concern is addressed. Another thing is to tax all end consumer services. Like I said, we are a service-based economy now. There's no economic justification for favoring service industries. You're de facto giving them a little bit of a tax subsidy because you don't tax them. There's no reason for that. It should be equal, it should be stable, it should be neutral, but you should also account for business inputs. I can't stress this enough. But the key thing about taxing services is you've got to be careful that you do it all at once. So if you decide to pick and choose which so you want to tax lawyers this year, or you want to tax accountants this year, you can bet that the lawyers are going to come out of the woodwork and say, no, but the taxidermists aren't being taxed. I need to have an exemption. You need to do it all at once, and you need to be strong when those people inevitably come out and ask for an exemption, because they will. It happened in North Carolina this year, which we'll get into. The original plan that was floated in the Senate was a very broad tax on services, and there was a lot of pushback because it's hard to tax things that you haven't been taxing forever, but you've got to be careful to do it all at once. And then you can bring down the rate in conjunction with this base broadening to kind of take the sticker shock off, make sure that make it more revenue neutral if you're not interested in lowering revenues overall. So I think that the takeaway from this is, where do we go from here? There's a common theme I think you'll all notice is that we can broaden our bases and lower our rates. That's the right way to go. There's lots of opportunities to do that in Georgia, and I'm excited to talk to the senator from North Carolina about how they were able to do that in your neighboring state.